Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar, the first one for the week, and of course, the first that we will speak about commodities. Most precisely, we will speak gold. As we have covered so far from the beginning of the month, we've been talking about the three major currency pairs, graded by importance and volatility. Now we will, of course, talk about the two major commodities that are mostly traded. This is gold for today's session, and on Friday at the end of the month we will talk about oil. However, in the means of trading gold, that is definitely as a necessity to poke a little bit in the history of the performance of this particular commodity, as well as the importance of the dollar strength, as of US dollar strength. So far as we spoke about the dollar and the fundamentals that are standing behind it, we understood what major economic events throughout the annual performance of the index. We will of course connect all of these to the gold as a price, which is denominated usually in US dollars, as of our trading pair. So for us, gold, we can also connect this to silver as well, but particularly we will speak about gold, is the most complicated asset to price. Okay, none like stocks, currencies, and other type of commodities that are mostly dependent on fundamental data of the stock price. The country on physical demand and supply of the commodity itself is more importantly for us to understand. This is what many call prediction demand inventory and its specific formula. So once fundamental data about the asset comes out, even an inexperienced type of investor or trader can understand most price movements, as well as we witness on our day-to-day basis trading when we assess the fundamental data on the economic calendar. However, once fundamental data about the specific instrument comes out, pricing of gold on fundamental basis is far more difficult, because by tradition, let's say, prices depend on valuation of other assets and on differences between US data and the rest of the world. This tradition, of course, ladies and gentlemen, may lead to price difference between the type of the so-called paper gold and real metal. That, of course, contradicts the formula, as we mentioned, which is, one more time, production, demand, inventory. What, of course, is interesting, as we think that gold is valued somehow indirectly. It is, of course, a relative valuation and describes a particular difference between the US economy and the rest of the world one more time. This makes trends driven by fundamentals very difficult to understand. Maybe, therefore, gold is far more subject to, let's say, like or dislike, or love or hate, all right, of the metal itself. Many analysts, however, if I have to compare, basing their arguments to buy or sell the metal or gold on limited set of fundamentals, or only on technicals, that what is. However, gold is often focused on exploration of, let's say, public debt and or on real interest rates, okay? Which, of course, the falling gold price, let's say in 2013, 2014, even we witnessed that in 2015, all investors were caught on the wrong foot, and consistently they speak about conspiracy theories and market manipulation, let's say. However, if we have to be somewhat more realistic to be able to argue that gold brings no income but has a cost of carry, we will see that this particular opinion is also the cause during inflationary or stagnationary period in the United States that capital gains on gold are far higher than the total return of stocks or bonds, including dividends and coupons also. Our argument today that we will set upon gold and its price will of course express the strength of the global non-US economy versus the GDP growth and expectations on real interest rates in the United States. That comparison, ladies and gentlemen, will give us the real view of what exactly is moving gold price. Now, speaking of which, there are many factors that can day to day shift gold prices up or down. But there are mainly 6 major events or factors that can determine the gold price in a general view. Also, this implies that during the global recession many years ago, gold prices are by far not at their highest point. To grasp this particular sentence, its meaning, more easily we will determine the specific 6 major fundamental drivers of gold prices. Now, 6 here I will state as minor events like price movements of other commodities in combination with global demands for these commodities, which is the so-called indirect pricing of production costs. Also, global and in particular US inflation, often driven by rising money supply, the so-called trade and growth imbalance against the US, and the resulting deficits that might of course accumulate in the so-called fear factor. Nonetheless, there are 3 more, such as the central banks that their activities like money printing or gold purchases and sales result in gold difference in exchange rate. Also the real interest rates, and in particular the ones in the US that are interest rate compared to inflation and wages, that might culminate in financial repression. Nonetheless, on the final, but of course also very important, private physical demand and supply, in the short term, technical support and resistance levels might be of course more important for gold than for other particular assets. The reason is the thing that we mentioned above, which is the whole specter of gold fundamentals, which are so difficult to understand, to connect with each other in order to result in any kind of direction overview. Now let's head to the first of today's topic. We will be talking about gold move, which is connected to other commodity prices and of course global growth of gold, which is of course positively correlated to other commodity prices. And this is for two reasons, ladies and gentlemen. The cost factor. For gold, for example, if any of you guys have heard about gold dredging, now this is a particular way of mining gold from, let's say, seabeds, riverbeds, any kind of other very old, should we say ancient, lakes or something like that, or in any other way of saying, you can also, dredge gold from rocks or soil that has been known to contain large quantities of gold nuggets. This is a very common practice in Alaska, also in many parts of Africa, Asia, as well as South America. Not only, but in California, in U.S., is also a very, let's say, vast fields of gold mines where they can dredge for gold nuggets, as well as pretty much the U.S. is one of the largest territories where you can very easily dredge for gold. Of course, the vastest is Alaska, not only because of the gold rush in the beginning of the 1900s, but mostly because of the, let's say, tectonic plates and so on and so forth, the causes of the formation of this particular metal from high pressure. Over there, those layers are much much higher and much close to the common hand to excavate from the ground and sluice, as most of you might know that, to sluice through and refine that particular gold. Enough of the ways, of course, of excavating gold from the ground. This is one of the minor factors that also have to be considered. However, a lot of companies are dredging gold for millions of dollars every year. Like what I'm saying, millions of dollars, tens of millions of dollars every year. And this is one of the factors, because dredging for gold, you need to move a lot of material or dig very big holes in gold ore mining. Also, the second interesting here is the demand factor in China. All right, also the global oil benchmark, copper as well. In the last decade, which is of course the proxy for Chinese investments, and they're closely linked. This is oil, copper, gold. Recent developments, if we have to just skip a few years back and have a look at 2013 and 2014 as years, both copper and oil got under pressure by the slowing of Chinese real estate investment. High Chinese interest rates and the regulation of Chinese housing market were the law that disallows to buy a second home. That helps to calm potential overinvestments. High supply of U.S. oil, for example, and slower global growth weakens oil prices. This we'll also see in the webinar in 2 days from now, on Friday. For now, I'm only stating a few parts that are relevant to global gold prices. The competition between OPEC supply and U.S. shale oil further reduces oil prices. Cheaper commodity and oil prices negatively affect the gold price as well. This was the correlation we saw a couple of years ago. Right now, This is not the case. Mostly, what is important is our second topic, and this is the gold price correlated to global money supply and inflation. It's what's driving gold prices today. Metals appreciate, let's say, until 2011, with rising money supply and inflation in emerging markets. Due to the high portion of food and energy in the so-called consumer price index basket or emerging markets, the effect of rising commodity prices, ladies and gentlemen, on inflation is stronger than the developed nations itself. So, since the summer of 2011, also during 2008-2009 recession, global inflation figures fell, and consecutively also gold and other commodity prices as well. If I have to add to that, this is also silver. The relation between the change of US CPI inflation brings the common view of the gold price, which is related to US inflation, and of course difficult to sustain in a world where emerging markets soon achieve half of the global GDP rate. Let's go even backwards in history. 1970s, during the end of this period, the gold bubble, however, US inflation was the main driver of high gold prices. This is what we spoke a couple of minutes ago. It was the real interest rates, and particular those in the US, which are also compared to inflation and wages. That's when we saw this particular gold bubble. Also, if you have to take under consideration the change in trend in 2013 and 2014, this was the tight Chinese monetary policy with the central bank, lending rates of 6%, limited locally financed investments, while at the same time the end of US tapering also indicated market tightening. All of this we saw in our present trading days. Mr. Ben Bernanke, he was the one that brought the US economy back on its feet, all right, by cutting interest rates, by delivering the quantitative easing program, billions of dollars of bond buying programs. So the limited inflows of energy markets in the emerging markets and the available money in these former drivers of global growth also cause food and energy prices in Europe to be the indication of weak emerging markets. Also, tight monetary policy, no matter if China or the US is, let's say, the poison, the so-called, for the gold price, making it deter its value. The third important factor for gold is that prices appreciate with a global imbalance in trade, debt, and growth against the United States. The rising imbalance against the US strengthens the gold market. Now, if we have to make a connection between gold and the silver, okay, if we have to correlate them, typically they rise together with economic improvements in emerging markets. This would be Europe when the US cannot cope with this pace. What we see is in our teachings so far today, as we explained, still in our present days, the euro has a strong positive correlation to gold. This often moves together. When the euro goes up, the gold also appreciates. This particular third factor, ladies and gentlemen, as we're unveiling right here, is the most important one because it represents a pre-indicator for inflation. Now this is in our head topic. We spoke about global and particular US inflation, which is often driven by money supply. Central bank intervention in times of crisis also activates like money printing for gold purchases and sales. Real estates, let's say, real interest rates, financial repression, but also for the availability of money to push up commodity prices. Now, all of this we spoke in our head topic, 6 minor factors. They're combined into this third major factor, which is debt and growth against the United States, which appreciates gold prices. So the former often translates into, let's say, high oil prices and fuels, which of course gives more and more impact over the fear factor, so that the US consumption may collapse like it did during the 2008. The Federal Reserve fights this particular fear factor with easy money, printing additional cash. Between 2009 and the summer of 2011, emerging markets continued their ascent, but high oil prices and the weak housing market hampered the US and its economy. A similar situation happened in the 1970s, as we spoke earlier, with South America and Europe showing far higher growth rates than the US, which appreciates gold. While, of course, these global improvements helped the oil prices in exchange, the US trade deficit increased, causing indirectly in higher US debt, as we saw the US debt ceiling. They kept rising and rising, this debt ceiling. This caused gold prices to skyrocket, nearly reached $2,000 an ounce. So, as to rising US debt and trade deficit, countries like Switzerland, Germany, Japan, and recently China exhibited current account surpluses and high savings. Those particular effects can be even either invested in the local economy, investments like real estate or fixed assets that boost commodity prices, and factors like price movements of other commodities in combination with global demand for all of these commodities can boost gold prices. Or, of course, those particular profits can be exported with the financial account to the balance of payments via capital outflows, like central banks in the emerging markets often hedge against inflation. German or Swiss companies, however, invest their trade surplus worldwide, which is a very smart thing. If capital outflows are smaller, for example, than the current account surpluses, then the currency is a rare good. It typically appreciates. When the yield of foreign investment is too low, however, then surplus countries prefer to invest in the local economy, often in real estate, depreciating gold prices. Finally, These particular investments in the local economy may also be invested in human capital, like wage rising, boosting the US dollar, devaluating gold price. Also, not at the last place, a reduction of imbalance that weakens the gold price. Recently, rising wages and stronger value of the yuan, however, have reduced the competitive Chinese advantage, particularly the Chinese current account surplus that has considerably weakened. So higher Chinese wages led to a run on the gold until 2011, but weakened competitiveness in the emerging markets. So from 2012 on, the United States has been stronger in today. Stronger investments in real estate prices in the US tend to weaken gold prices. So what we saw was the mortgage applications, negative 3.5% from previous 11.5% positive. And we automatically saw appreciation with additional $5 only today of gold price. And of course, we're expecting to rise at least $5 more before the interest rate decision today, which is at 18 GMT. However, getting to that point, major expectations are for unchanged policy. They will leave probably at 25 basis points with no change, which will definitely leave the outlook for December rate hike, which is right now at only 7% possibility. That will boost gold prices. So let's have a look at recent developments until about a year ago, November 2014, as we're entering in November after the weekends this week. The U.S. trade deficit, ladies and gentlemen, excluding petroleum products, is strongly increasing and slowly approaching the record of 2006-2007 again. Now, what happened then was a rate rise from a record zero with 25 basis points. From then, that's nearly a decade, 9 years so far and up to date. That interest rate was untouched. Trade and current accounts in Europe. Now, what's more important here and curious to see is that also in South Korean current accounts and the one in Japan are strongly improving as well. Why am I adding to South Korea? Well, basically because of the output of goods, exports, Korean goods, Samsung, Kia, any other automobiles and additional electronic devices which have proven themselves in today's markets that are valuable enough, as well as the Japanese and American merchandise. All right. Now, speaking of which, this reflects rising margin and rising cash in their companies as opposed to American ones. The non-petroleum deficit is strongly in favor of the surplus currencies like the euro, the franc, the Korean won, and the yen in Japan. But thanks to weak oil prices, the market is still on the global bull path. Due to the divergence between falling petroleum deficit and rising non-petroleum deficit, the situation for gold is rather mixed at this stage. That explains the indecision on the market, the place where everyone is highly expecting interest rate change, like interest rate hike in the US. Also, this particular indecision in this country as the global economy, major economy, is causing gold to fluctuate with $100 for just a week. This, ladies and gentlemen, tells us that the particular indecision leaves gold markets in a sideways range, particularly wide sideways range, which gives an opportunity to trade it very successfully with a technical analysis on short to mid-term basis. On the long term is what we need to consider of today's session with the most important 6 factors that determine gold prices. And that leads us to our 4 important factor today, gold prices which are correlated to central banks' activities. Let's talk about that particular correlation. So having in mind that for decades central banks in Europe and emerging markets rallied on buying the US treasuries or gold. The reason was that less developed countries have the potential of high wage increase as compared to the richer Americans. Higher wages translated into inflation, and the European or emerging market currencies raised their risk appetite. This could trigger again inflation, higher wage demands, more inflation, and finally potentially even higher inflation, hyperinflation. So holding US treasuries or gold fulfilled a double advantage. The central bank had inflationary resistance that could profit on appreciation of the dollar or of the gold price. So what does that tell us? That after the rate increase, the Federal Reserve's move, we will see expensive gold and expensive dollar. Well, how does that cope one with each other? Well, for now, gold price is mostly let's say driven by dollar and the strength of this US currency. But in the future, gold prices will not be that well driven by day-to-day data like fundamental factors on the calendar. However, it will mostly be driven by supply and demand, most definitely because of the inflation. And gold is seen as hedge against inflation. Basically, central banks, hedge funds like the SPDR Gold Trust, the largest hedge fund of gold, all of the above will run to buy physical gold, indefinitely rising its value because there will be less on the market. And the supply-demand curve will be what's unfavorable for the supply, driving higher gold prices, which is what all we want to see as a strained uptrend in gold. Until then, until that particular moment when everything is now revealed, all cards are on the table, we can only expect indecision on the market and mostly sharp moves down. Holding US treasuries, as we mentioned one more time, or gold, are the advantage of the central bank. Today, the Fed is still the leading central bank in the #1 system of central banks. because many central banks peg their currency against the dollar. But still today, the Fed feels the need to fight the weak U.S. economy within its double mandate of maintaining low inflation and reducing unemployment. The Federal Reserve often implements easing measures and expands its balance sheet. Typically, gold prices rise and the US dollar weakens. One more time, let's cover this. It's an important base. After quantitative easing executed by the Federal Reserve, because private investors and some central banks move out of the dollar into gold. So when a central bank implements a quantitative easing, the expect is usually positive for gold because it devaluates local currency. And this is executed so far by Bank of Japan, the European Central Bank, which definitely is negative for gold prices because it strengthens the US dollar. Emerging markets rallied more on buying US treasuries because they started their assets after some period when the gold prices were already relatively expensive. So you see, it's like pricing in the market for something that is expected to happen. So between, let's say, 2010 and 2012, more of the central banks in emerging markets reduced their dollar share and bought gold instead. China right now holds about 1.7% of gold reserves. India, however, is relatively higher, 10 times higher. They're having about 10% of the global gold reserves. Brazil, however, only 0.5%. In particular, countries with current account deficit, like India, the 10% bank gold holdings, or Belarus with 30%, Egypt with 25%, often prefer gold to stabilize their currency, while Western central banks still stick with their former IMF rule not to buy gold anymore. This is where the imbalance comes from. Major economies driving gold market down because they're much more reluctant to buy gold as a reserve. This drives us to our next topic, which is the gold, its price, which rise with falling US interest rates, with the financial repression. Still today, ladies and gentlemen, American funds are the most important drivers of financial markets. Therefore, gold falls when those investors and the US Treasuries becomes more attractive relative to gold. In times of high interest rates, however, as we mentioned, the gold price is weak and vice versa. Gold price, one more time, falls when US economy improves and the changes of the federal funds rate also increase, even if this rate hike is far in the future. That is why we saw a so big decline in gold price when when I say they, I mean the Federal Reserve, the central bank over there, said that the June interest rate hike is not going to happen because they further wants to see improvement in the labor markets and, of course, economic conditions and so forth, yada, yada, yada. That drives the interest rate hike further into the year, and we saw increase in gold price for a short period of time. But when they actually started talking about September rate hike Even 3 months ago, the price started falling because we were expecting some better numbers, and on every good number we see each day, gold has been sold on the market until the time came when they withhold their reaction, and they drove gold price back up, hitting a bottom of, what was about then? Let me check. It's about September. We saw one more time 1100, close to 1100, and until recent days to 1189. Now this is close to $100 in about 27 days. So this is a month, and we saw the gold appreciating with $100. Still, there is a lot of resistance to gold's upside, ladies and gentlemen. However, the prices are right now boosted because of the speculations of even next year's rate hike, which gives more time for us to bet on gold. Wages as underlying factor for interest rates are the gold price. Let's put it this way. Let's see that during the 1970s, inflation expectations and consecutively rising wages in response to oil shocks and rising oil prices, the gold price moved upwards together with wages and oil prices. Consecutively, the Fed managed to keep inflation under control. Company margins and stock prices rose again. The Fed, however, destroyed gold price in general. Until the year of 2013, the opposite picture, however, arrived. US wages had been nearly steady for years, but company margins were increasing. The wage share of GDP is declining, while companies could profit on global supply chain and cheap labor in emerging markets. Leading economics are also in favor for rising wages. And the recent developments show in 2014, effectively, US companies are happy to share more staff and pay higher salaries, driving gold prices down. That drives us to our final topic of today, the physical supply and demand. I will keep it short because in our early teachings, when we spoke about the so-called fundamental analysis, we covered gold and oil in particular in separate sections of supply and demand, as because it's far different. The factors that we stated above, and those are the final 5 factors currently visible. In the supply and demand situation, however, for gold and other commodities like silver, for example, still price movements are often more reflected in modern instruments like ETFs and futureses. Electronic trading, let's put it simple. ETFs are made possible that new investors and traders to be able to buy metals much more easy. With the figures of Asia, however, after the crisis of 1998, gold prices have been seeing a big bull run. One reason is that China and even more India have a strong gold tradition and massively increased their physical purchases. The Indian savings rate, however, is over 20%. A bigger part of savings more are into gold. However, some small part of gold's demand is in industrial use, often in emerging markets, which of course reacts more strongly to physical demand supply and demand in gold. Let's summarize by not rejecting other commodity prices, especially oil, that reacts very strongly on temporary disruption of supply on, let's say, weekly basis, where we see the Energy Information Administration report, and nonetheless, a day earlier, the American Petroleum Institute, two different agencies, but one of it has a bit more power, like the Energy Information Administration, which is the governmental body that gives this the supply and demand report. This, however, is not the case for gold. Temporary disruption like a strike in South African miners, as we saw a few years back, does not affect the gold price that strongly. It can be a sudden fluctuation for just a few hours, but that is it. In other commodities, however, it can drive the market months to come, what we're seeing with oil. But that, ladies and gentlemen, we will leave for Friday. Thank you very much for joining us today, where we saw the gold market, how easy it is to actually predict future price movements, despite the fact that we have separate data every day for the US economy, which is the major moving force in gold market. But with the lack of any kind of US information, other more emerging markets, Asia, Europe, so on and so forth, can actually show us where US stands and what the gold market is up to. So that's it for today. Thank you very much for joining us. I'll see you next time when we will speak oil. Most oftenly, we will make a few correlations again with natural gas, which will be a very small part of our webinar. However, an integral part to see what we can expect when one of it is more than the other, giving the fact of seasonal supply and demand. Thank you very much for being here. I'll see you on Friday. Don't forget to sign up. See you then. Bye-bye.